All right. Well, hello, Matt. Sorry, that was a little embarrassing. We could probably have a few people join us late now. Apologize for that, everyone. I'm glad people are sticking with us. First 2 minutes, we'll just wait for a couple of people to join us. Tweeted it out. I don't know, Matt, if you saw my tweet. I don't know if you want to tweet it too, or we can wait a few minutes
Yeah,
and you could tweet it.
I did tweet it out as well.
Okay,
I think
good.
most people do watch it on replay though, so maybe we
That's
can.
okay. All right, let's get started then. So, for the outline, me and Matt, well, just a backstory, Matt and I met for the first time at this conference in Miami we're at this week. It's exciting to see Matt, and for the first time in person. We've been working virtually for the past 10 months on this business, and so that was great. And what else, Matt? We came at probably the worst week of the year in terms of market volatility.
Yeah, we were thinking like, okay, January would be a good time. We think Tesla will be doing a lot better. Our thesis will look smart then, and we'll look like a couple of smart investors who can show off some great returns. And it seems like the exact opposite has happened. So, but I
Yeah,
think tomorrow is kind of the key day. Obviously, we've
yep,
got the FOMC meeting which is going to be. I think that's probably the single biggest factor that'll move markets. And then obviously Tesla earnings right after that. So. Netflix kind of started off earnings season on a sour note, but I do think
yep.
with Tesla in particular, but a couple other names as well, I think there will be some kind of clear
Microsoft
winners
today.
who are
Yeah,
showing really great operational results, and I think that'll help call markets as well.
yeah, absolutely. I mean, we've been talking about, the Fed. We've been talking to some other potential investors at this conference, institutional type folks that are probably not a good fit for our fund. Actually, we realized as we started this conference, but it was a fun experience nonetheless. But it seems that the consensus is that the Fed is going to probably soften its language, kind of react to the market downturn, and do something like soften its language so that it doesn't want to spook the markets into a bear market. That would be pretty,
Yeah.
that would not be a good look for them, and the Biden administration and politics, they would not like that either. It would make, if the economy started getting less confident because of markets crashing, it would just not be a good look for the Democrats, especially. So, I think that there's reason to believe the Fed will soften its language, and this week is sort of like the apex of uncertainty and volatility, and whether we just kind of stabilize at this level and slowly trade sideways for a while, or we kind of rebound quickly, I'm not sure. But we're very bullish on Tesla nonetheless.
Yeah, I think it's very unclear what markets are going to do from here. But you've got really great growth names trading in like value stock territory. I mean, looking at our portfolio right now, which all the names that we like have been hit really hard in the last 2 months. But like Lemonade is trading. We were just talking about this, like just a little bit higher than their cash balance, which is like they've got a great valuation backstop with that. Tesla's trading at a forward PE based on my estimates of about 50. And so like if you start looking at the PEG ratio on that, it's like insanely cheap. So I think if these companies execute on their business, which is, we talk a lot about macro, and like macro is important, you got to watch it. It's obviously driving markets right now, but over the long term, it's really going to be the business fundamentals that drive shareholder value. And so I think, with prices where they are right now, it's a really good time to be deploying capital. So
Yeah,
as disheartening as it can be kind of on a day-to-day basis, I'm incredibly optimistic about where we go from here.
yeah, me too. I mean, in this volatility, like, it reminds me a little bit of 2008, or even more recently 2020, where the market can suddenly drop 5% and rebound in the same day. Like yesterday was really a roller coaster. I think there's just so much uncertainty with the norm. The liquidity providers today are high frequency traders, not market makers anymore. Market makers are kind of
Right.
required, were in the past the liquidity providers, decades ago. But in the last, 10 or 15 years, high frequency traders have competed the market makers out of business, and they don't have to follow the same rules. And one of those being they don't have to maintain two-sided quotes at all times. So when they feel times are uncertain, they can just pull their liquidity altogether, press a button, and turn off all their bids and offers. And then all of a sudden, the spreads are wider and markets move much faster when someone's buying or selling. And I think we saw that yesterday. And so I think if the market can stabilize somewhere, after the FOMC kind of put some more certainty into what's going on with rates in the near future, then I think you'll get liquidity providers coming back slowly again, because they just don't want the risk of trying to provide it's not profitable for them to keep providing liquidity or two-sided quotes when they feel like the market could be very volatile, right? So once they come back, you'll see less drastic movements again. And whether we get a 1% down day or 2% up day, that, to me, that's probably going to be the norm again for a while, versus these wild swings of 5 or 6% up and down, which is just crazy. It's not fun for anyone, really.
Yeah, I mean, VIX is at a crazy high right now. But like even looking at last week, Friday obviously had a big kind of options expiration day. There was a lot of really good commentary around that. Is it to me the price movement really made sense on Friday when you looked at like the delta hedging exposure of expiring options, and people have to decide what to do. You either take delivery of the shares and you exercise these deep in the money calls, or
Yeah.
you sell them and roll it into something else. But either way, if that's kind of the prevailing market sentiment, delta exposure, like the delta hedging of the market makers, is going to kind of accentuate downward price movements. So to me, there's a lot of kind of explainable reasons why the markets are kind of doing what they're doing right now. But the opportunity is pretty drastic on the upside in my mind. Obviously there's uncertainty, and I think if this Russia Ukraine situation really deteriorates, I think that could have a detrimental effect. But even that, like in the long run, will be kind of noise compared to just the operational execution of the companies. So you got to just have thick skin during these times, I think.
Yeah, thick skin and be willing to ride these ups and down. As long-term investors in the names that we're convicted on, this, this is in the realm of possibilities of what we sort of put as a possible scenario of, this type of volatility. So we knew that this type of down move is if not likely, very possible, and it's happening. And even more of a down move is very possible. I'm not sure it's likely, but you just have to be ready for these roller coasters, but have the eye on the prize on the long term, like the fundamentals of the company, Tesla in particular. Like, we're very convicted that it's still going to be the largest company by the end of the decade, if not much sooner. And so we're happy about it. And when we get a chance, we try to get more shares or whatever at attractive prices when we can. So earnings tomorrow. That's the big day, Wednesday, the FOMC line. I think that comes out at 2:00 Eastern time. And then like 2 hours later, you got Tesla earnings being released. It's just like a crazy 2 to 4 hours there. And the earnings call right after that with all the controversial questions and such being asked. And so it's just, it's going to be exciting for like a good 4 hours. I don't know. I feel like I'm looking forward to that, even though it's like cringeworthy, because you don't want to, when these things happen, you just don't know how the market's going to really react. I mean, I'm hopeful that the market's going to be positive. We've had so much downward pressure the last several weeks that you think the rubber band's got to come back, and this could be the catalyst tomorrow. But what if it's not? What if tomorrow causes more down movement, and the stocks are tanking another 5% tomorrow, and Tesla earnings for some reason doesn't surprise or wow people enough, and it goes down 5 or 10% after hours? I mean, that's also in the realm of possibility. Short term is anything can happen. But the more chances you get at these types of opportunities, more often than not, it'll be positive, because I feel like we're set up for some positive, returns again after such a downward move the last few weeks. And with Tesla earnings, I think gross margins, so you have any new insight on Tesla earnings, Matt, or any updated thoughts? I mean, tell everyone what your projections are in the model again, and what your updated kind of projections are.
Yeah, so we walked through this in detail a couple of weeks ago, but essentially, I'm estimating $2.95 of adjusted EPS. I think consensus it's something like $2.33 right now. So huge upside potential, if I'm right. In terms of like the automotive gross margins is the biggest thing. I do think we could surprise on credits, but there's a decent chance the market discounts any sort of news on that regards. But I think like we were talking about this before, it's just the fundamentals of the company. Like when Tesla disclosed like the absolute blowout deliveries in Q4, the stock rallied to $1,200. Like it was kind of, and people were thinking, okay, new all-time high tomorrow, and then it was like down 7% like for 2 weeks in a row,
Yeah.
every single day seemingly. So like the fundamentals of the company hasn't changed. The earnings print was already locked in at the time, like that P&D report was released. And so really, I think all that's happened is like the price that you can buy like this upside potential looks even better now, in my mind. So I don't have any new insights per se. I'm sure we'll have a ton to digest tomorrow, and I don't know, maybe we'll have a chance to do a live stream or something to digest it in real time. But yeah, I think it's going to be a big quarter. I'm pretty convinced, like unless I'm drastically wrong on how efficient Shanghai in particular has become in the price increases that we're rolling through. Like to me, I would be absolutely shocked if the numbers came in close to like 233, which is where Wall Street thinks it is. And maybe it'll
Yeah.
be 270, maybe it'll be 250 even. I think Gary Black's around 250. I'd be pretty disappointed if they were that low, but I don't think the general market participants are kind of expecting 290 to $3, which is where most of the Tesla Twitter analysts are coming in right now.
Yeah.
So
Yeah.
it's the disconnect seems like it's never been higher than like right now at this moment.
Yeah, yeah. I mean, you got to think that the whisper number, which is sort of like defined by like buy side institutional portfolio managers or analysts, which are not the sell side analysts that publish the research that we all see, where you get the 233 consensus or whatnot. But the whisper number by the buy side analysts, you got to think that's much higher than the 233. But is it 250 or is it 270? I don't know where that whisper number is that they with that whatever they call it. So it's sort of got to beat that whisper number, I think, for that itself to have a positive net reaction on the stock. So we'll find out, I guess, tonight. But IBM, value stock as it is, I guess had some pretty decent earnings, and it popped a little bit for a little while last night. It didn't stay there, I guess. I don't know what it's doing today,
You
but
can't trust these after hours numbers. Like what we've
no,
seen in the last couple of weeks is like just it doesn't really matter what the numbers are. It doesn't matter what the stock does after hours. Like the next day, it's the volume
yeah,
just has been coming in and dictating things. So I don't know.
yeah. Yeah, you can't trust it. I mean, with this market, Tesla could be up, 10% after hours and give it all back by the open the next morning. That certainly is in the realm of possibilities. But, the fundamentals, nonetheless, the fundamentals of Tesla are going to gain a lot of strength from this earnings report. We saw the Moody's upgrade last night. What are your thoughts about them? And did you have a chance to take a look at that?
Yeah, so it's it's so ridiculous because they're like the upper realm of junk territory now,
Yeah,
which
one
is just
level from
crazy.
investment grade. Yeah.
Right. But they've got like more cash on hand than debt on the balance sheet. They've got like crazy free cash flow. This is maybe getting a little bit into nerd territory, but there's a really good like financial metric that measures bankruptcy risk essentially, which is
Hmm.
it's called the Altman Z score. And
Okay.
so like for creditors, that's what they care about. Like they don't really care about the upside potential of your stock. They want to know about like the downside. Are you going to like burn so much cash flow that you can't pay your debt back?
Yeah.
And so there's this Altman Z score, which like if you have like a one, you're a very high bankruptcy risk. If you have like a three, you're pretty solid. And
Hmm.
Tesla's Altman Z score right now, James Stevenson posted this a while ago, is 21. So it's
My
like
gosh.
even like with backward looking financial metrics, like Tesla has a fortress balance sheet. Their cash flows are like phenomenal, and like this to have like a junk bond rating right now, with the kind of cash flows and like a 90% equity to debt ratio that they have. If you're looking at like market cap compared, it's actually a lot higher than 90% must be. Um, but like it makes no sense. It's just such a slow moving kind of organization to it's kind of befuddling. Like these are the same groups that got all the risk within the financial system during 2008 so wrong, and we're essentially selling credit ratings for fees, and we're not really doing any sort of diligence on like the underlying mortgage-backed securities, which were so like critical to the unraveling of the financial system at that time. They were getting all these
Yeah.
AAA ratings, and now like on the opposite end of the spectrum, something super safe. And Tesla just has, a junk bond rating. It makes zero sense to me whatsoever.
Yeah.
Good to see the rating. The market didn't seem to care about it too much,
No.
but it's
They need to
still
get to
not right in my
investment
mind.
grade. Yeah. If they just were one notch higher, it would change maybe some institutions' ability to buy Tesla. There's certain rules, certain funds have to follow, mutual funds or whatnot. They can maybe only buy a certain amount of stock unless it's investment grade, or they can't buy it at all unless it's, I don't know. So, it could be trivial, or it could be marginal, or it could be impactful. I guess we'll find out eventually when Tesla does get upgraded to investment grade. We'll see in the following days or weeks if that has a more meaningful impact on the stock price at that time. So yeah, that's interesting. I mean, I see some comments about the Ukraine situation with Russia. I mean, it seems like some people are in Ukraine, and people in Ukraine are thinking that it's high likelihood of Russia starting a war, invading. I know there's a lot of talk about that, and some people think some of the market volatility is related to that. Do you think it's related to that? I'm not so sure. I mean, I think that's a scary situation. I'm not saying it's not. Just like the Afghanistan situation, a year or two that's still going on. But you don't want to see, governments, or political calamities happen that causes lots of, human suffering. Obviously, that's, not necessary a lot of the times. Maybe it could be dealt with more politely, or not politely, but more peacefully,
More,
more
yeah,
peacefully.
humanely, yeah.
So, but at the same time, I'm not sure the markets are so worried about that. I mean, I know there's saying, oh, it could disrupt the whole energy, industry in Europe and whatnot. But we've had, like, I could be wrong, but we've had all kinds of political, you know, unrest in Eastern Europe before, and in the Middle East, and yeah, sure, headlines love, can bring it up and talk, and it's worrisome, but I'm not sure the actual U.S. stock market has tons of jitters because of that itself. What do you think, Matt? Do you think
Yeah.
it's a big deal or no?
Well, like I always hate to take very serious, issues like this and only comment on like the impact to the market and like our portfolio. So
Yeah,
like first and foremost, like my prayers, good and thoughts go out to all the families that are dealing with
yeah,
this. And like
me
this
too.
is a human, potential tragedy in the works, and I think we shouldn't lose sight of that. Um, but that said, like it's certainly not helping market jitters right now. But
Hmm.
I do tend to agree with you that it's probably not like the cause of the significant downturn that we've seen in the last couple weeks and days. I think the potential for Russia to like halt natural gas exports in the middle of winter is a very like real risk to the European economy. But we've actually seen that they did that. I don't remember the exact time frame, but something like 5 years ago. Um, they kind of just exercised their power and stopped natural gas exports. I think it was to Poland. I could be wrong on that.
Hmm.
Um, but like they've got some like pretty serious heft they can throw around. And so you could imagine if they did that for, extended like a whole season of winter, that could have much more drastic impacts than like a day or two or like a week long issue. Um, so like if they start going down that route and really play hardball like with the economy, and then you got tanks rolling in Ukraine, um, that could certainly kind of spark fears. I think the biggest risk to markets would be if there's some sort of um, like contagion where other European players come in like to try to defend Ukraine, and you get like
Hmm.
the larger powers kind of facing off against each other. I mean that's not a prospect that investors would like to see where you've
No one
got
wants to see that. I don't
yeah.
know if that can happen either, though. Like, I can't imagine a
I don't think
scenario where
so.
you
It
have
seems
actually people
unlikely.
like armies firing guns at each other again. Like, it's a different world. It's like
There's
cyber
proxy war
war
is
and
the thing right
proxy
now.
wars.
Yeah.
Yeah, like militias hired to fight other militias. It's a different world. Drone strikes. It's a different world. So I don't know what it's going to look like. Hopefully, nothing too terrible. I mean, it's not good no matter what. but I have no idea
Yeah,
what it's going to look like. It's not going to be people, tanks rolling in shooting their guns. The tanks are just kind of a symbol, I feel like, at this point.
I think that's right. Yeah, but looking forward, it's very easy to get caught up in like the all the horrible news and the risk in like a
Yeah.
1 to 2 week time frame. But looking to like 1 year from right now, I think this will not be a major issue. I think the Fed will have changed policy a little bit, but not in any sort of dramatic fashion. I'd be surprised if rates are much higher uh, than like 2.5%. And then you're going to have kind of more operational excellence from companies, and just given a long enough time frame, I think a lot of the things that we're so worried about right now will seem like smaller impact items. So I do think there's just huge upside right now because everyone's in fear, right? Like people are seeing so much red day after day, week after week. I'm sure margin calls are kind of exacerbating some of
Yeah.
the selling going on right now. But you know, you can't go underneath some valuation thresholds for extended periods of time without money kind of flowing back into them. So
Yeah.
I'm
Yeah.
very optimistic on even kind of like the medium term right now.
Yeah. Yeah. Me too. Um, well, why don't we just go to a bunch of Q&A at this point, unless there's something else you wanted to bring up. I mean, there's a lot of people who have questions about the market volatility. We're as nervous about it as everyone, but we'll try to go through as many questions about whatever it is, Tesla earnings, stocks, market volatility as people can. Unless, Matt, do you have anything else you wanted to bring up or first?
No,
Or?
let's dive into
Okay.
Q&A. I think we lost a bit of time on our technical issues
Yes.
at the beginning, so let's jump into
Sorry
it.
about that, guys. Question from Alex B. Based on your experience, what are the criteria for brokers to increase the margin rate using interactive? He's using interactive brokers. So brokers have the right to increase margin anytime they want. Whether they want to have a reputation of increasing margin more conservatively than every other broker, that's another question. Because that reputation means they're going to lose some business, obviously, if they have that reputation. So it seems to me, like in my experience working in the brokerage industry, that there are some brokers that are a bit more conservative. I'd say interactive brokers tends to be on that, but that's actually a good thing in some cases, because if there is a major flash crash that's real, other brokers, their customers could be in debt more than the equity they have in their accounts, and the brokers might not have enough capital on their balance sheet to pay for it. It could be a bad situation in a world-ending black swan, not a world-ending, but a real bad black swan event. If they suddenly wake up and the markets are cut in half, for example, like you could actually lose all your equity at other brokers, maybe. But at someone like interactive brokers, I feel like they're less likely. They have much more capitalized, well capitalized, and they do automatic margin liquidations and such. So in such a bad situation, I think you're more likely to retain your account if the market got cut in half overnight, for example, before people could liquidate their positions, and high leverage people. So there's pros and cons you got to think about. But in my experience, when the market's really volatile like it is now, or a particular stock gets super volatile, with GameStop or not, and we saw with GameStop a little bit too, where it sort of seems like all the brokers sort of move in some sort of unison. And if they all decide, if they sort of decide to increase the GameStop margin all at once to 100%, or ban short selling all at once, or maybe in 2008 when the market crashed, they all said, okay, we're increasing futures margin requirement by 50% all at once. So sometimes when there's a major market meltdown of a stock or an industry, it seems like all the brokers kind of coordinate their efforts in some way. But I mean, the margin requirements can be increased anytime by the broker, so just be prepared for that. I would say typically they give you a warning ahead of time, but it's not required. And if you look at the fine print of their agreements. Okay, from Andrew Brazil, Tesla retail investors have, rightly, I believe, developed high expectations for Q4 earnings. To what extent do you think those expectations have now been baked into the share price? Matt, what do you think here?
Yeah, I don't think they have been. I mean, we talked about this a little bit so far already, but we've seen the stock just falling. So on the back of really good production and delivery numbers and rising earnings per share estimates, both from Wall Street, but especially from retail investors. Um, in that backdrop, you've seen the stock plummet. So to me, you have a disconnect between kind of what the share price has been doing and where expectations have gone, or at least where I would maybe say like the most informed analyst expectations have gone. So I don't think we've seen this in the past sometimes where there's been a like sell the news kind of situation, and of course that can certainly happen here again. Anything's possible in the short term, but it seems more likely than not to me that the magnitude of the disconnect between what like Tesla Twitter analysts are expecting and what Wall Street's expecting, it's about the biggest disconnect I've ever seen. And you have that in a backdrop of like plummeting share price. So I don't really think that the like increased earnings expectations are really in any meaningful way kind of baked into the share price right now. So yeah, I don't want to get too kind of like predictive on where I think the share price is going to go, but based on some of the other setups we've seen going into quarterly prints, it seems like it's a better setup than most in recent memory.
Yeah, I mean, if the stars line up too, I mean, I've talked about this Dave Lee on the this weekend's investing call, and I think I tweeted about it once. But if the stars line the right way, and like the FOMC is softer, and the markets, the buyers come back in force, and Tesla has surprises most of Wall Street. It wouldn't surprise us probably, but it would surprise most of institutional finance with really upside earnings. So if the stars align just right, I could see Tesla having like such a historic stock price reaction to this. Whether that's 10 or 30% chance, I'm not sure, but there's certainly a chance where there's sort of like a historic thing going on here where the market's rebounding anyway, and Tesla has historic, numbers with a huge disconnect from what was expected by institutional, and it just compounds. It'd be like, you know, it would be something we talk about years to come. Like, remember that fourth quarter earnings print in 2021 that happened when the market was collapsing and Tesla saved the market, or whatever it is. This narrative could be something like that potentially, but the stars can align. I can see the stars aligning for that potentially. I'm not. It's not probable, but it's certainly in the realm of possibilities in my mind.
Well, especially since you've got Elon on the call too. I mean, you could have like better macro
surprise
news
there
coming out of the FOMC meeting. You could have a really strong earnings print, and then you could have some kind of ambitious, really good news on like a product development front. And so if you have those three factors, I could see what you're.
What if he says we got battery
suggesting.
costs even lower than we said on battery day? Like, what if he says, oh yeah, we figured out ways to get the battery cost even half the price of what we thought, or something like that. I mean, maybe investors, it's time for them to eat it up, now that Tesla does what they say and they start realizing that. Who knows?
Yeah.
We'll see. Yeah. Exciting possibility, So from Jim Chemo 11, do you think that China is stealing Tesla's IP? If so, what could Tesla do to protect itself? So I do think there's, a passive sharing of IP on maybe manufacturing efficiencies or manufacturing capabilities. And there was that kind of claim that XPeng took some code early on from Tesla's autopilot technology. But, I think Tesla is innovating faster than even anyone could copy them anyway. So even if China is, copying them, to some degree, they might be better at copying them than anyone else in the world, which it seems could be the case. And that's why Chinese EV makers are like the serious contenders to Tesla versus anywhere else in the world at this point. But there are certain things, that like the Tesla full self-driving technology with their, AI, Tesla AI, and the neural networks and, real world AI applications of that I think Tesla is so far in the weeds on that it's probably very difficult to copy in my mind. So I think there's some kind of unique inherent advantage there with Tesla that's very hard to kind of carry to another company, even if it was somewhat, unless it was like, stealing like the top 5 AI engineers and they could bring all the code with them, which, that would not happen. But I just don't see that kind intellectual property being taken by another company very easily. I don't know. Do you have any thoughts, Matt?
Yeah, I completely agree with that actually. I think even if they were to steal like the latest up to date, 10 version 10.9 of full self-driving, that's not particularly useful to any other company because they don't have the same hardware setup as Tesla. They don't have the kind of AI backbone to iterate on that to get to the point where it could potentially be like an autonomous vehicle in the future. So I think
Mm-hmm.
even if they could steal that somehow, like Xpeng apparently did, I think it's going to be problematic for that to actually be useful. Um,
Yeah.
but I do think it's probably pretty likely that there's a good amount of, whether there's a difference between like intellectual property and kind of like company know-how. And
Mm-hmm.
I'm sure there's a good amount of like manufacturing know-how that the Chinese are picking up just from how efficient the Shanghai factory is. So I think that's a reasonable assumption that you'll see the other Chinese EV makers continue to get really good at manufacturing. Whether it's stealing like individual like designs from the Shanghai factory, or it's just kind of a more benign like like workplace knowledge that they're just getting from having Chinese workers at the site. I
Yeah.
think it's reasonable to assume that that's going on.
Yeah, and China does. I mean, Tesla gets a lot of benefits from China. I mean, it's not stealing Chinese work ethic or anything like that, but they get a huge advantage just being in China with the work. And we see the production out of Shanghai that could not be done anywhere else in the world, in my opinion. I don't even think Austin or Giga Berlin are going to be able to ramp up as efficient. I don't think they'll ever be as cost effective as Giga Shanghai. I just think China is a manufacturing monster, and they're
Hmm.
just going to outperform. I mean, look at Foxconn, what they've done. I just don't see. I think Tesla gets tremendous advantages from working in China as well, and I think those advantages are worth more than maybe some copying of their efficiencies or whatnot. We'll see, but you combine it, it's mutual to some degree. So
Yeah.
we'll go to the next question. Next question. Oh, by the way, what's up, Farzad? I see Farzad in the chat here. I was on his channel a few weeks ago. Really, really cool. His channel. If anyone hasn't seen it, check it out. So from Hit That Bid. Oh, this is from Yashu. Okay, Yashu's here too. Do you think Tesla claims the tax credit on the Q4 report? Matt, you have some thoughts on this, right?
Yeah, I think he's probably referring to the NOL kind of carry forward. So they've got these net operating losses from their whole history. Essentially, they were not profitable, so they had billions of dollars in losses, which can be offset in the future. But they actually never booked those because in the past it has been improbable in the eyes of the auditors that Tesla would be profitable enough to recognize the benefit of the tax losses that they can carry forward. So, and it's a really large number. I don't remember the exact number off the top of my head, but if memory serves me, it's over $1 billion.
Yeah.
So I think it seems like now more than ever seems like it would be the right time to claim that the kind of write up on the net operating losses. There's essentially like a haircut that they're applying to it on the balance sheet. And so if they reverse that haircut, then you'd have a one-time benefit kind of flowing through the income statement. But I don't think it's going to be particularly meaningful. I mean, even if they do have that, you'll have this like crazy gap earnings print of I don't know, over $1 billion, and that would probably get some headlines. But I think most sophisticated investors would say, okay, well, that's only like an accounting mechanism to kind of true it up. There's some marginal benefit in terms of kind of lowering like cash taxes paid going forward, but the tax when you recognize that isn't really that impactful. So to me, I don't think even if they do claim the whole amount, I don't think it's going to be a really material kind of impact for for the stock. So I don't
Yeah.
um,
Yeah, me and you
put a
differ
whole
on
lot of
this a
weight
little
into
bit.
it.
Like you and James Stevenson, I think even Dave Lee thinks it's sort of likely, but I am skeptical. I sort of differ on this. I remember a year ago thinking it was like, somewhat likely it was going to happen this quarter or next quarter, and it hasn't happened. I think they're being ultra conservative and waiting until full self-driving goes to wide release, and that'll be probably later this year in my mind. But I think that's when they'll
What are you
really start
talking about,
pressing.
the deferred revenue balance or
Yeah, yeah.
the tax loss? Because there's
Oh,
because those are two different things actually. Because there's
okay,
the tax the net operating losses, which is just like a tax, accounting treatment thing,
okay.
and then there's the deferred revenue for the full self-driving, and that's more meaningful, I think. But I
Yeah,
agree with you. I think the full
I was
self-driving deferred
confusing it.
revenue balance is unlikely to
Yes,
be recognized in Q4. I think it's unlikely
that's
in
what I think.
Q1 even, honestly, but we'll see.
Yeah, yeah, yeah. Sorry, I confused the two, but I'll have to. All right, next question. Let's see here. From Jarno Tiny, when do you think the semi starts to flow in numbers from Tesla? That's a good question. Maybe part of the product roadmap announcement by Elon will say something about that. I know we all know that they're giving their first deliveries to Pepsi pretty soon. They've been battery constrained for a while. I have someone on Twitter DM'd me who's been tracking very closely the CATL relationship with Tesla and CATL's progress and
Hmm.
the batteries. And he sent me like a spreadsheet he's been working on and seemed pretty legit. And he's got a lot of followers actually, and he seems to understand what he's talking about. He really believes that they are no longer battery cell supply constrained, even without the 4680s being in production yet. Like that CATL has really ramped things up, and that Tesla's going to really be able to produce a ton more cars now, even without the 4680 yet. So that'd be great. I mean, I hope that's the case. So maybe that's a nice upside surprise. And if that's the case, I could see Tesla Semi coming faster than expected. Because I think a lot of the holdup is, they don't have enough batteries for the Model Y and Model 3 demand. So, that's what they've got a good production lines building out efficiently with good gross margins. And, up to, I think most people think that once they kind of saturate that enough, then they'll ramp up Tesla Semi. But that could be, no one knows when that's going to be. They got to catch up with the battery constraints with supply and demand versus the Model 3 and Model Y. So that could be, I was assuming that was going to be like until 4680s are really ramped up, and that could be a year or two still. I don't know. So this guy who DM me seemed to think it's like now is the time where they're not battery constrained anymore. So I don't know. Do you have any thoughts about it, Matt?
Yeah, I do agree with you that it does. Even in the language on the last couple earnings calls, they used to talk about battery constraints, and they talked a lot more about semiconductors recently,
Mm,
as opposed to batteries being the constraint.
mm,
So I'm sure it's always kind of a moving target of what particular supply chain issue is like the single biggest bottleneck at any given point in time. But to my mind, it seems like the build out that they've done to really kind of um, optimize the original Gigafactory in Nevada has gone very well. They're building out, the new dedicated Megapack factory, which is 40 gigawatt hours. And that's
mm.
going to go a long way, I think, towards alleviating some of the supply constraints that they were seeing on the car side. Because now they're not going to need to dedicate any of the automotive like battery supply to those stationary storage applications. So that's a really big deal in my mind. But I don't know about how that translates into when the semi numbers start coming in. I'm kind of in my own mind thinking it's going to be like pilot projects and like maybe deliveries in the dozens for the next year, maybe two. Um, and I think they want to probably get Cybertruck out first and then focus on like semi and roadster.
Yeah, yeah. From Aaron Gray, now that Lemonade trades at 3x next year's gross premium, how do you guys plan on managing this stock over the next year? It's funny you say that. We were just talking about that with a potential investor, Lemonade. Um, I mean, we're trying to model out. We need to model out how long it would take to, burn through all their existing cash, which we think is at least 2 years, perhaps much longer, especially if they're growing. And but we think they're going to grow fast enough
I,
where
I,
that's not even going to be an issue. I mean, what do you, Matt? Do you wanted to say something?
yeah, I think I'm not sure where that three times next year's gross premium number comes from. I think it's actually a lot higher than that.
Mm,
But in my mind, the kind of backstop to valuation right now is on their cash balance. So they've got, I think it's 1.1 billion. It's about $1 billion in cash on the balance sheet. And the stock is trading, at under $2 billion or like about $2 billion right now. I was actually just looking at the financials before we jumped on here. In the last 12 months, they burned $115 million in operating cash flow. So
Wow,
they've
that's it
essentially
for
got
12
like
months.
10 years. Yeah, for
Oh my
12
gosh.
months. They've got like 10 years then of cash burn at the current
Wow.
rates, which you'd have to believe if they're successful in scaling the way that they think they are, then that burn rate would decrease over time and eventually flip positive. So in my mind, they've got this like huge war chest, which can kind of sustain them. There's very little bankruptcy risk. At this point, I think that the risk is they are kind of unsuccessful in scaling, and so they do kind of burn through that cash pile over the next 5-10 years, and the stock comes down against that kind of backstop in value. But the upside potential is so massive on the other side, I think, that I don't know. I think it's a great time to be going aggressive into Lemonade right now, because I think that
Yeah,
the
I just
metrics
checked
are
1.75 billion market cap. That's crazy for the potential it has.
1.75.
Yeah, I mean, it seems like a really potentially high payoff if right. I mean, it's a binary outcomes, situation like we talk about. We don't know necessarily. We talked about it on our Lemonade interview with Paper Bag Investor, if anyone hasn't seen it. But at the end, we gave our odds. I said it's like 50-50 whether they're going to be really successful or they kind of dwindle out and get acquired eventually for pennies on the dollar from where they are now. That's my projections because I know I'm biased already from researching it and blah, blah, blah. So I put 50-50. But Matt, you were like 80-20, right? I mean, you were pretty
Yeah.
aggressively in thinking that the binary positive outcome of it being successful is like 80%. That's pretty high conviction.
Well, their customer satisfaction is just so high, and it's hard to bet against a product that customers really love. So they've got a lot of work to do to execute to really kind of earn that like 10x return that we think is possible. But
Mm-hmm.
I think they've got all the right pieces in place. There was another
Yeah.
question on here. I'll just talk to it briefly, but somebody was asking about the questions of the customer acquisition cost, and I think we have done a deep dive into a lot of those kind of current metrics right now. And they don't look super great, to be honest with you. Like you're essentially acquiring customers at a cost of I think it's about 2 years worth of
Choose a
premium.
premium. Yeah.
Um, and
That's what
they
it
only
looks like.
last
But
about 3
yeah.
years on average. So like that looks really terrible. And so I get why that would be scaring people off, and I kind of get why the stock is kind of falling when those are the metrics that they're posting. But if you look a little bit deeper, and especially their optionality to increase premium per customer, that to me is like one of the biggest like unheralded benefit that they have, because the average customer, I think, is I did a calculation. Lemonade's getting about $140 in revenue, so not premium but revenue per customer right now.
Mm-hmm.
But it's because they're on all these low margin, low dollar value products like renters and pet insurance, which are like small dollar value, obviously. But as those people in their like kind of young 20s, which is their kind of core market right now, age up and buy houses and get married, and kind of go through that life maturation process where they their dollar spend becomes a lot more valuable. It's very likely in my mind that a good chunk of those customers will stay with Lemonade and will upgrade to auto insurance and will upgrade to home insurance. And so then you'll have a
Mm-hmm.
situation where you're not only growing your customer base by, I don't know, call it 30% a year, something like that, but your premium per customer has the potential to about 10x if they're super
Mm-hmm.
successful. And so then like all the financials of the company look drastically different if that scenario pans out. So I think it's there's a very decent chance that kind of thesis pans out over 5 or 10 years.
Yeah. Yeah. No, I think that's true. 5 or 10 years, very confident. And yeah, the next 2 or 3 years, it could be, they just acquired Metro Mile, that I think 6 months or so is when they expect the acquisition to kind of go through officially, and could be another several months before integration looks, you see results of their
Yeah.
actual integration with Metro Mile. So it could be a while before you see some real progress. That's hard to say, but the long term, we're very bullish on it.
Yeah, there does seem to be a lack of short-term catalyst though, which is kind of
Yeah.
the risk with Lemonade. You may be sitting on paper
Yeah.
losses for a very
Yeah.
long time, and then it might just pop
Yeah.
overnight, but it might be in 2027 and all of a sudden it goes like 15x like
Yeah.
Tesla did. That may be
Yeah.
the way it pans
There
out.
there is a lot of, I mean, we study Tesla so much, but there is actually a lot of similarities between Tesla and Lemonade in some senses, like the business model disruption. Like traditional automakers had to go through dealership models, and Tesla's direct
Hmm.
selling. Lemonade, traditional insurance have all these kind of agents, or and Lemonade just goes right to the, there's no real agents necessary. It's all direct to consumer with the app and technology. So
Hmm.
there's a lot of interesting parallels: vertical integration, building from the ground, their own thing, infrastructure from the ground up for the most part. So there's a lot of interesting parallels there. All right, next question from Stan Marge. What do you think of Rocket Lab launch frequency, 39 days on average, 2022 included? I mean, the launch frequency or the cadence of the launches, I think, is largely delayed because of the COVID restrictions in New Zealand, is my understanding from previous interviews, listening to Peter Lynch talk about it.
Peter
I
Beck.
think if the Peter Beck, sorry, not Peter Lynch, Peter Beck. So I think if the once the COVID restrictions in New Zealand, which is pretty strict about it, once they sort of get relaxed at some point later this year, we're hoping that business can kind of be less frictional for getting people to see the rockets or the stuff based. And Peter Beck, you said, hasn't even been to the U.S. in years, for example, and they're building a launch site in the U.S.
Hmm.
So there's a lot of seems like there's a lot of slowing or delaying of the launch cadence because of the COVID restrictions with them, and we're hoping that when that relaxes, that they have a lot of product to move on their floor. They said in a recent interview, and I believe it. They have a lot of customers signed up, waiting to kind of, but the customers need to inspect the technology or deliver the rock. There's lots of reasons they need to travel to New Zealand or whatnot, and it just slows everything down. I don't know. Do you have any thoughts, Matt?
Yeah, I think you broke it down really well. I mean, it's not like other businesses where you can just like do a zoom of your rocket launch for your $10 million satellite that you developed, and you're trusting
Yeah,
Rocket Lab to develop or to launch successfully. Like they want people on
yeah,
the ground, delivering that, making sure that everything's going well, and that just hasn't really been possible with New Zealand lately. So that has caused a bit of a delay in kind of their launch frequency. Ultimately, kind of like what you're saying with Lemonade, though, I think Rocket Lab's a longer term play. So
yeah.
anything could
It's even
happen in
longer
the
term than
next
Lemonade
one or two.
potentially. Yeah, Lemonade, you
Yeah.
might see progress in 1 or 2 years after the Metro Mile kind of integration kind of takes effect. But Rocket Lab could be 2 to 5 years until like the market comes back to valuing the space industry. The space industry is kind of like latter half of this decade, a bigger part of the economy. That's how I kind of view it. It
Yeah.
was hot, last year. We wanted to get a piece of it with what we thought was undervalued relative to the, top, SpaceX, by far the top player in the space industry that's evolving. And so we believe in Rocket Lab as being the second place to SpaceX, and we think it could catch up in its market cap valuation comparison to SpaceX, significantly. And if when the space industry is kind of appreciated more by investors again, we think Rocket Lab will be a big beneficiary of that.
Yeah, I think there's a big misunderstanding in the space market, which is you just kind of alluded to, though, and it does remind me of Tesla a little bit, where people didn't know how to think about Tesla, from 2012 to 2019, say.
Yeah,
And I think the same is true right now. Like if you look at the relative valuations of a lot of these kind of space startups, and kind of the ultimate TAM that they're hoping to address 10 years from now, like Rocket Labs makes a ton of sense. A lot of the other ones in the space don't. And I
mm,
think there's not a lot of sophistication among investors of trying to see kind of beyond the launch business and what does the ultimate market look like, and how much is it growing. So I think it may take some time for the market to kind of sort through the winners and losers in this space because
yeah,
it's so new.
yeah. And there's a
Maybe
ton of these like great space industry, companies that selling great stories. A lot of SPACs in the space industry, in the last like 6 months or whatever. But we really like Rocket Lab because they're really executing on what seems to be the hardest thing, which is launching to lower Earth orbit. They're the only one that's successfully done it, more than once, other than like
yeah.
SpaceX. So and they do it consistently, and they have customers, and so all
Yeah,
these
and
other
I don't know,
space company SPACs are kind of like just big stories. I don't know which one is going to pan out. I don't want to try to guess which one is going to execute or not, to be honest.
Yeah, we didn't talk about this either, but did you see they had their successful like helicopter catch tests
I saw that a couple of days
past week,
ago
I
or
think it
something.
was.
Yeah,
Yeah,
they caught it every
they
time, they
didn't.
said, right?
Yeah, so that was really good to see. I mean, that's a huge amount of innovation to be catching first stage like booster rockets with a helicopter. And
Yeah.
obviously they weren't doing that for like an operational launch this time, but the tests went really, really well. And it's so interesting hearing Peter Beck talk about it because it seems like that's like something from a Mission Impossible movie that'd be super hard. And he's like, no, 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 like this is very easy relative to like heat shield, for example. So he's got like a such a deep technical knowledge and is very kind of straight shooting with what's actually hard versus what just like appears to be difficult, but actually from a technical standpoint is not. So, but it's good to see them kind of continuing to march down this path because that bodes well for their cost control going forward.
Yeah, absolutely. Yeah. I read somewhere that they got that helicopter catching idea from like maybe the Russians or maybe it was the US military. Some military was doing it, trying it at some point in the past or something. So it's not the first time people have tried to catch it with helicopters is what I'm saying. I think it was tried, but it is innovative for a commercial, it hasn't been done in a long time and there's no private companies that seem to be doing it. So it's kind of cool to see them executing on that.
Yeah.
All right, maybe one more question. Let's see. Okay, let's do one more question from Mike. How realistic do you think it is that the multiples drop by half so that all valuations will get cut in half and not come back up for a longer time period, like 10 years? That is a great question. I think it is a very realistic possibility everyone should be prepared for. I don't think it's probable, but I do think it's realistic. I would put it at 10 to 30% chance, 20% chance, and it's significant. You don't want to, play Russian roulette with a gun that has 5 barrel, and so you don't want to use margin if you're going to be totally screwed if everything gets cut in half from here, right? So that's what we're
Mm-hmm.
trying to prepare for, that type of outcome, because it's very possible. Everything could get cut in half. In my mind, it doesn't, whether it should or shouldn't, that's not the question. Whether it will or won't,
Right.
that's the question. And I think it's possible. It shouldn't, in my mind, in most investors' mind, probably, but doesn't mean it won't. And if it does happen, I still think the best companies like Tesla will ultimately be higher than where it is now. Might take a few years, obviously, if it gets cut in half first, but it will ultimately be higher than where it is now. But there's a lot of stocks that may never recover to where they are now. They might, become, most corporate people have to realize most stocks, most companies over the long run die, or they don't fizzle out. It's very few companies that outperform the S&P 500 that make up, like, there's all kinds of statistics about it, but like I think I read somewhere like there's like 5 companies in S&P 500 over like a 10-year period that made up like all of the returns, and without those 5 companies, S&P 500 would have been like 0% over 10 years or something. I don't know, something like that. So there's this huge skew. The generational companies mostly are what make up the returns of the market, and Tesla, we believe strongly, is one of them. So that's why that's our highest conviction name. I don't know, you have anything to add, Matt?
Yeah, no, that's a really great summary. I agree with everything you're saying. It's kind of like the Pareto distribution where
Yeah.
like a very small minority makes up like the vast majority of the kind of winners or the wealth. But I think that certainly applies in stocks. With this question in particular, I think it's a really great question. Because valuations were definitely high, like in last year and in 2020 even, particularly for growth companies. I think there's good reason for the multiples to have been as high as they were, but ultimately, I think probably all boats rose too much, and I think what you're going to see is that you'll see some losers where there are companies that didn't deserve those sort of multiples that don't have the kind of underlying business fundamentals to warrant those high valuations. So those ones, I think will clearly not do well. But over the course of 10 years, I do think you're going to have. It's going to be very clear that there will be a handful of winners like Tesla, like Lemonade, like Rocket Lab, that will get an outsized share. They'll have kind of premium returns, and they will have premium valuations
Yeah.
for the fact that they've got this kind of premium market positioning based on the underlying fundamentals. But in the medium term, yeah, anything can happen, and so I think it's a really great question.
Yeah, I mean, 10 years seems a little strong. I mean, I can see market back. It's possible, though. I would say 20% chance it gets cut in half for a few years, but 10 years seems a little strong. But anyway, a
Yeah,
few years could be very
well, yeah.
problematic for people on margin. Yeah.
And if there was like recession risk, I think is something we don't talk about too much. We talked a lot about macro factors, but Elon has talked about there potentially being like an economic recession this year. And if you did have that kind of issue as well, I think that could exacerbate it. You imagine if it's like a, I don't know, 3-year, 4-year recession, it could certainly
Yep.
take longer than that for valuations to kind of get back to, you know, where they were a year ago.
Yeah. Yeah. Absolutely. Well, it was a great chat, Matt. We got to go to a meeting soon, I know, in our conference here in Miami. But you know, sorry. Thanks for sticking with us with the difficulties early on, and this is recorded on our YouTube live channel for people that want to watch it. And next week we'll be on again, and a lot to talk about with Tesla earnings, FOMC meeting, macro market craziness, I'm sure, for the next few days. So we'll see next week. We'll see you all next week.
Yeah.
Okay.
Thanks, everyone.